Hello everyone, I am the Wall Street Poe who aspires to bring everyone wealth freedom. Welcome to my channel, baby. I often post my latest options strategies in the fan group. So many fans want me to popularize the gameplay of options. So in today's video, I will divide it into two parts to explain my understanding and thoughts on options. The first part, I will introduce the four most basic option strategies. I will use the simplest language to tell you what each strategy is, how to use them, and how much profit they can bring and what risks they involve. Meanwhile, I will also explain the pricing of options, which not everyone can explain clearly to you. Then the second part will cover my practical operation strategy of options. You can choose according to your own experience to watch this video. Without further ado, let's get to the point. The first basic strategy is to buy a call option, on call. When the stock price goes up, buying a call option is the simplest and most direct strategy we can do. Call options, simply put, it means you spend money to buy a right to buy stocks at a fixed price. For example, let's say I buy a June 20th expiration date NVIDIA call options with an exercise price of $120. If we put it into the previous definition, on June 20th, no matter where NVIDIA's stock price goes, I have the right to buy NVIDIA stock at $120 per share. Since it is a right to buy, it must cost money. As of the close on March 28th, the market price of this option was $6.7. It should be noted that $6.7 corresponds to the right to buy one share, while one option contract bundles 100 shares. So if I buy this option, I have the right to buy 100 shares of stock. So the total cost is $670. On June 20th, if the stock price is above $120, such as $140, then I can exercise my rights to buy NVIDIA stock at $120 per share, which means I earn $20 per share, and because I have paid $6.7 per share option fee, so the real net profit is $13.3. Since one option corresponds to 100 shares, the total gain is $1,330. Have you noticed that since buying options has a cost, only when the stock price exceeds the exercise price plus the option fee can I make a profit? That is to say, 126.7 is my break-even point. If the stock price only reached 125 on June 20th, my per-share earnings after exercising the option would be $5, minus the cost of $6.7 per share. I actually lost $1.7 per share, which means the total loss of the option is $170. But if the final price does not reach $120, your maximum loss is the cost of buying the option, which is $670. Buying a call option is a way to amplify gains when you confirm that the stock is in an uptrend. What if the stock price is in a downtrend? Is there any way to profit from it? Alas, this is the second technical strategy we are going to talk about, buying a put option, long put. Buying a put option means you spend money to buy a right to sell the stock at a fixed price in the future. Suppose I buy a June 20th NVIDIA put options with an exercise price of $105. That is to say, on June 20th, no matter where NVIDIA's stock price goes, I have the right to sell NVIDIA stock at $105 per share. As of the close on March 28th, the market price of this option was $7.9, so the total cost is $790. On June 20th, if the stock price is below $105, such as $95, then I can exercise my right to sell NVIDIA stock at $105 per share, which is equivalent to making $10 per share. Since I have already paid the option premium of $709 per share, the real net profit is $201 per share, and the total option profit is $210, and the break-even point for a put option is the strike price minus the option premium, which is 105 minus 7.9 equals 97.1. So as long as NVIDIA's stock price falls below 97.1, I will make a profit, but if it does not fall to 97.1, I will incur a loss. If the stock price eventually rises above 105, I will lose all of my $790 cost. Basic strategy 3, selling cover calls. The essence of selling cover calls is selling call options. Selling one cover call applies to 100 shares of stock as collateral, providing someone else with an opportunity to buy your stock. You're selling a promise to sell shares at a fixed price in the future. If you believe the stock price will fluctuate or rise slowly in the current phase, then selling a cover call is definitely a good option. For example, if I own 100 shares of NVIDIA stock, and I think it's unlikely that NVIDIA will reach a price of $150 in the near future, then I can choose to sell a cover call expiring on June 20th. I have a call option with a strike price of $150. The option price is currently $1.19. If I choose to sell, my account will immediately receive the $1.19 option premium as my profit. If NVIDIA's stock price doesn't reach $150 by June 20th, If the option expires and I can continue to hold my 100 shares, then if Nvidia's stock price exceeds 150, my 100 Nvidia shares will be sold at the exercise price of 150. In this transaction, while I earned the option premium, I also forfeited all the potential gains the stock could have made above $150. On March 19th, investment tycoon Duan Yangping announced on his personal social media that he had bought 100,000 shares of Nvidia stock at $92. In reality, Nvidia's stock price has never fallen below $100 recently, so how did he manage to do that? This is closely related to the cover call we just discussed. While buying 100,000 shares of Nvidia at $116.70, it simultaneously sold 1,000 cover calls. Since the premium for a call option is $2,400, 1,000 call options would amount to $2.4 million. A simple calculation will show us where the 92 price came from. In summary, the advantage of selling a cover call is that regardless of whether the stock price rises or falls, I can earn a premium up front, which in turn lowers my cost basis. Even if the stock price falls, I can minimize my losses. The disadvantage is that if the stock price surges above the strike price, I will be forced to sell. Selling shares at the strike price forfeits all gains above that price. Some curious readers might ask, if I don't already own the shares, can I directly sell call options? The answer is yes, but I don't recommend this method. Selling naked calls has a maximum loss limit. There is no upper limit. For example, Tesla's stock price was around $220 on March 10th. At that time, you believed that short-selling sentiment towards Tesla was high and its performance was poor, so you judged that the stock price would not rebound in the short term. So on that day, without owning the underlying stock, you sold a call option with a strike price of $240 that expired on March 28th. However, in the last week before the expiration date, Tesla's stock price rose rapidly, reaching a high of $290, and finally settled at $260 on Friday. The option buyer will exercise the option, and you'll need to first buy 100 shares of Tesla stock at $260 each, and then sell them at $240 each, resulting in a total loss of $2,000. However, if you had bought 100 shares of Tesla stock at $220 each on March 10th and then sold the option, your final profit would have been the option premium plus the $2,000 profit from the price increase. This is why I recommend selling covered calls instead of naked calls. Basic strategy 4, selling a self-put put. Selling a put means you're willing to buy the stock at the strike price, and for this commitment, you can collect a premium up front. So when is a MyPool a good decision? When the market is stable or experiencing minor fluctuations, and you're willing to buy the stock at a price lower than its current price, then a MyPool is a good option. For example, if Nvidia's current stock price is $110 and you only want to buy $100 worth of Nvidia stock, but you think that price is unlikely to fall further, then you can choose to sell, for example, a put option with a strike price of $100 on June 20th. On June 20th, if the stock price drops to, say, 95, then you must buy 100 shares of Nvidia at a price of 100. However, if the stock price is above 100, the option expires and you earn the 600 yuan premium for free. It is worth noting that selling put options requires margin. Make sure you have enough cash to buy the stock at the exercise price if the stock price falls below the exercise price. For example, with this option, you need a margin of 100 by 100, which is $10,000. If you don't have that much cash in your account, you can still go for a MyP, and I don't recommend it because of the higher risk. The above examples all use the expiration date as an example. However, if you want to trade your options before the expiration date, you need to have a basic understanding of option price fluctuations. I want to emphasize that the factors influencing option price volatility are truly complex. It can't be explained clearly in just a few words. Back when I was studying at MIT, I was completely baffled when Professor Martin talked about option pricing. But if you want to trade options, then you at least need to understand every point I'm about to make. Option prices are like a cake, divided into two parts, intrinsic value and time value. Intrinsic value is the actual value of the option. Simply put, it's how much money you could make if you exercise the option right now. For example, you might buy a call option on a stock with a strike price of $100. If the current stock price is 110 yuan, then the intrinsic value is 10 yuan, because you can buy something worth 110 yuan for 100 yuan, and the price difference is your profit. If the stock price does not exceed the agreed price, for example, it is still 90 yuan, then the intrinsic value is 0, because you would not execute a losing trade. The time value refers to future possibilities. The value option it represents may change in the market before expiration, and no one knows if the stock price will suddenly surge. Therefore, time value is like buying the hope that you will pay to gamble on a future opportunity to make money. The longer the time horizon, the more valuable this hope becomes. The shorter the time frame, the smaller the hope and the lower the value. The total price minus the intrinsic value leaves the time value. Options are like a countdown timer. With each passing day, the probability of that future event decreases, and so does the time value. The rate at which the time value of an option decays is called theta. Theta tells you how much the time value decreases each day. For example, if theta is minus 0.1, which means the book value will decrease by 10 cents per day. But the decay of time value is not uniform. If the option is at the money, that is, the strike price is similar to the current stock price, the closer to the expiration date, the faster the time value will decrease. Why does the loss of time value accelerate? Because the closer the expiration date is, the stock's chance of reversal becomes smaller. The market will no longer be willing to pay a high price for hope. The time value will collapse faster. For the collapse of time value, we should also be careful about the IV crash after major events, which is the crash of implied volatility. IV stands for implied volatility. It represents the market's expectations for future price volatility. For major events like earnings reports and elections, no one knows what will happen. The market is as nervous as a frying pan and think the stock price may rise or fall sharply. At this time, IV will be very high. The time value part will be pushed up because the possibility increases. But once the event is announced, after the result comes out, whether it's good or bad, the uncertainty is gone. The market is relieved. Just like before the exam results are announced, you're nervous. Whether you fail or pass, you don't need to guess anymore. The disappearance of this uncertainty, IV will suddenly drop from the sky. This phenomenon is called IV crash. Option prices will also plummet, especially the time value part, because the hope and the chance to gamble is squashed by reality. At the end of this video, I want to remind everyone here that while options can bring huge profits, there are also huge risks. If you will be affected by huge floating losses and it makes you lose sleep over it, then please think twice before buying options. Thanks for watching. If you like my videos, please follow me. And what I'm going to do in issue 2 is I'm going to give you strategies. Please look forward to it. See you next time.